Hello, and welcome back to Bonnie's Life, your weekly dose of crypto clarity in a world of digital chaos. If you've been feeling like you're on a market roller coaster designed by a mad scientist, you're definitely not alone. The crypto market has been serving up a cocktail of heart stopping drops and tantalizing bounces, leaving even the most seasoned traders wondering whether to scream, laugh, or just pour another cup of coffee. Today, we're going to dissect this beautiful madness and give you a clear picture of what's happening, why it's happening, and most importantly, what you can do about it. We'll be analyzing the market from three distinct perspectives: the nimble short term trader who thrives on quick moves, the patient mid term investor who captures the bigger swings, and the visionary long term holder who plays the ultimate game. Whether you're a scalper, a swing trader, or a hodler, we've got actionable insights for you. We'll dive into the numbers, explore the fear and greed index, examine open interest and liquidations, and look at the global events pulling the strings of this crypto puppet show. So grab your notebooks, your favorite beverage, and let's make some sense of this beautiful, crazy crypto world. Let's start with the big picture and the market's current mood. The crypto fear and greed index, our trusty market sentiment gauge, is currently sitting at a chilly 19, which is firmly in the extreme fear territory. And this isn't just a fleeting moment of panic. We've been in this state of heightened anxiety for over a week now. This tells us that investors are spooked and the market is likely oversold. But here's the thing. For the contrarian trader, extreme fear can be a flashing neon sign pointing to a potential buying opportunity. As the old saying goes, be fearful when others are greedy, and greedy when others are fearful. This is one of those moments where the smart money starts paying attention. Now, let's look at the numbers that are driving this fear. The total cryptocurrency market capitalization is currently hovering around a colossal $3.025 trillion. While that number is still mind-bogglingly large, it's important to note that we've seen a slight 0.4% increase in the last 24 hours, which suggests a potential stabilization after the recent bloodbath. However, the 24-hour trading volume is a hefty $148.914 billion, which indicates that there's still a lot of activity and uncertainty in the market. It's like a sleeping giant. It might be quiet for a moment, but it could wake up and roar at any time. This volume tells us that traders are still actively positioning themselves, and the next big move could happen at any moment. Bitcoin, the undisputed king of crypto, is holding its ground with a dominance of 56.8%. This means that more than half of the entire crypto market's value is locked up in Bitcoin. This is a crucial metric to watch because a rising Bitcoin dominance often signals a flight to safety within the crypto space, where investors sell off their riskier altcoins and flock to the relative stability of Bitcoin. Ethereum, the queen of crypto, is holding a respectable 11.2% of the market share. Together, these two giants command a significant portion of the market, and their movements have a ripple effect on everything else. When Bitcoin sneezes, the altcoins catch a cold, and when Ethereum moves, the entire DeFi ecosystem follows. Now, let's put on our detective hats and look at the fundamental factors that are pulling the strings behind the scenes. The crypto market doesn't exist in a vacuum. It's deeply intertwined with the global financial system. And right now, that system is feeling a bit jittery. The biggest ghost haunting the market is the uncertainty surrounding the Federal Reserve's next move on interest rates. The words interest rates have become the boogeyman for investors, and everyone is on the edge of their seats, waiting to see if the Fed will continue its hawkish stance. A higher for longer interest rate environment makes borrowing more expensive and can dampen investor appetite for riskier assets like crypto. This is why we're seeing a strong correlation between the crypto market and traditional stock markets, particularly the tech-heavy Nasdaq. When tech stocks catch a cold, the crypto market often starts sneezing. We've also seen a significant deleveraging event in the crypto market over the past few weeks. A lot of traders were using high leverage, which is essentially borrowed money, to amplify their bets. When the market turned, these traders were forced to sell their positions to cover their losses, which created a cascade of liquidations and exacerbated the downward pressure on prices. According to data from CoinGlass, we've seen over $213.45 million in liquidations in the last 24 hours alone. It's a classic case of the domino effect, and it's a painful but necessary cleansing process for the market. It's a stark reminder that leverage is a double-edged sword. It can amplify your gains, but it can also magnify your losses with brutal efficiency. The total open interest across all crypto derivatives is currently at $126.90 billion, which shows that there's still significant leverage in the system. On the regulatory front, the plot is thickening. The European Securities and Markets Authority, or ESMA, is gearing up to take a more centralized role in crypto regulation across the European Union. This could bring more clarity and legitimacy to the space, but it could also introduce stricter rules that might stifle innovation. We're also seeing increased scrutiny on transparency in the crypto and fintech industries, which is a welcome development for long-term sustainability. And in Ukraine, a new crypto regulation deadline is approaching, which could have a significant impact on the Eastern European crypto landscape. These regulatory developments are like the slow-moving tectonic plates of the crypto world. They might not cause immediate earthquakes, but they are shaping the long-term landscape of the industry. And let's not forget the geopolitical factors. The ongoing peace talks between Russia and Ukraine are having a ripple effect on global markets, including oil and risk assets. The US dollar index is also showing some volatility, which can have an inverse correlation with Bitcoin. And in a classic flight to safety, we're seeing gold futures showing some strength. It's a complex and interconnected web of events. And as a crypto trader, it's crucial to have a bird's eye view of the entire global landscape. You can't just look at the Bitcoin chart in isolation. You need to understand how global macro events are influencing investor sentiment and capital flows. Now, let's get our hands dirty and dive into the charts. This is where the art and science of technical analysis come into play. We're going to look at the market from three different perspectives: the short-term trader, the mid-term trader, and the long-term investor. Each of these traders has a different time frame, a different risk appetite, and a different set of tools they use to navigate the market. Understanding which category you fall into is crucial for your success. For our short-term traders, the 1-hour and 4-hour charts are your battleground. You're looking for quick entries and exits, and you're not afraid of a little volatility. Right now, the 4-hour chart is showing us that Bitcoin is in a clear downtrend, trading below the 9, 18, and 40 period moving averages. This is a bearish signal, and it tells us that the sellers are currently in control. The immediate resistance to watch is the pivot point first resistance at $88,621. If Bitcoin can break above this level, it could signal a short-term trend reversal and a potential move towards the 9-day moving average at $92,892. However, given the current market sentiment, it's more likely that we'll see a test of the immediate support levels. The first line of defense for the bulls is the pivot point at $84,681. A break below this level would open the door for a move towards the recent low of $83,516. And if that level doesn't hold, we could see a quick drop to the next support zone around $82,048. For the short-term trader, the key is to be nimble. Look for opportunities to short the bounces and buy the dips, but be sure to use tight stop losses to protect your capital. The RSI on the 4-hour chart is currently at 43.84, which is in neutral territory. This suggests that there's still room for the price to move in either direction. A break below 30 on the RSI would indicate that the market is oversold and could be a good time to look for a potential bounce. For our mid-term swing traders, the daily and weekly charts are your canvas. You're looking to catch the larger swings in the market, and you're willing to hold your positions for a few days to a few weeks. Right now, the daily chart is painting a pretty bearish picture. Bitcoin is trading well below the 20, 50, and 200-day moving averages, which is a strong bearish signal. The key level to watch for the midterm trader is the 1-month and 13-week low at $80,742. This is a major support level, and a break below it could signal a continuation of the downtrend. If this level breaks, the next major support to watch is the pivot point second support at $77,293, and then the 52-week low at $74,496. On the upside, the first major resistance to watch is the 9-day moving average at $92,892. A break above this level would be a bullish signal and could open the door for a move towards the 18-day moving average at $99,069. However, given the current market conditions, it's more likely that we'll see a period of consolidation before we see a major move to the upside. For the midterm trader, patience is key. You're not trying to catch every little wiggle in the market, you're waiting for the high probability setups. Right now, the most prudent strategy is to wait for a clear break of a key support or resistance level before entering a trade. You could also consider using a strategy of dollar cost averaging, where you buy a small amount of Bitcoin at regular intervals, regardless of the price. For our long-term investors, the weekly and monthly charts are your guide. You're not concerned with the day-to-day fluctuations in the market. You're focused on the long-term potential of Bitcoin and the crypto space as a whole. And from a long-term perspective, the current market conditions could be seen as a major buying opportunity. The monthly chart shows that Bitcoin is still in a long-term uptrend. Despite the recent correction, the price is still well above the 200-week moving average, which is a key indicator of the long-term trend. As long as the price remains above this level, the long-term uptrend is still intact. The recent drop in price has brought the RSI on the monthly chart down to a more reasonable level, which suggests that the market is no longer overbought. This could be a healthy correction that is setting the stage for the next major leg up. For the long-term investor, the key is to have a strong conviction in the long-term potential of Bitcoin. You're not trying to time the market, you're simply accumulating a position over time and holding on for the long haul. The current market conditions could be a great opportunity to add to your position at a discounted price. As the legendary investor Warren Buffett once said, the stock market is a device for transferring money from the impatient to the patient. And the same could be said for the crypto market. So, we've dissected the market, we've analyzed the charts, and we've looked at the global macro environment. Now, for the moment, you've all been waiting for the trading strategies. How can we actually trade this market and come out on top? Let's break it down for our three types of traders. For our scalpers and day traders, the name of the game is agility. You're not trying to predict the long-term direction of the market. You're simply trying to catch the small intraday moves. Range trading is a solid strategy right now. The market is currently trading in a range between the pivot point at $84,681 and the pivot point first resistance at $88,621. You can look to buy at the bottom of the range and sell at the top. However, be sure to use tight stop losses, as a break of this range could lead to a significant move in either direction. If you're a more aggressive trader, you can look to trade the breakout of this range. A break above $88,621 could be a signal to go long, with a target of the 9-day moving average at $92,892. A break below $84,681 could be a signal to go short, with a target of the recent low at $83,516. You can also use the RSI for scalping opportunities. The RSI on the 4-hour chart is currently in neutral territory, so you can look for overbought and oversold conditions. A move above 70 on the RSI could be a signal to go short, while a move below 30 could be a signal to go long. However, always confirm with other indicators, as the RSI can sometimes give false signals. For our swing traders, the key is to be patient and wait for the high probability setups. Trend following is a viable strategy in this market. The market is currently in a clear downtrend on the daily chart, so you can look to trade with the trend by shorting the rallies. A good entry point for a short trade would be a test of the 9-day moving average at $92,892. You could then place your stop loss above the 18-day moving average at $99,069 and your target at the 1-month low of $80,742. Alternatively, if the price can hold the $80,742 support level, it could be a good opportunity to go long, with a target of the 9-day moving average at $92,892. Dollar cost averaging is also a prudent strategy for mid-term traders. This involves buying a small amount of Bitcoin at regular intervals, regardless of the price. This can help you to build a position over time and reduce your risk. This is a great strategy for those who believe in the long-term potential of Bitcoin. but don't want to try to time the market perfectly. It takes the emotion out of the equation and allows you to accumulate systematically. For our long-term investors, the strategy is simple: buy and hold. You're not concerned with the short-term fluctuations in the market. You're focused on the long-term potential of Bitcoin and the crypto space as a whole. The current market conditions present a potential buying opportunity to add to your position at a discounted price. Consider strategies like value averaging, where you set a target for the value of your portfolio to increase by a certain amount each month. If the value is below your target, you buy more. If it's above, you sell some. This strategy can help you to buy more when the price is low and sell some when the price is high. You could also use a buy and rebalance strategy, where you set a target allocation for your portfolio, such as 60% Bitcoin and 40% Ethereum. You then rebalance your portfolio on a regular basis to maintain your target allocation. This can help you to take profits from your winners and reinvest them in your losers, which can lead to better returns over the long run. The key is to have a strong conviction in the long-term potential of the technology and to not get shaken out by short-term volatility. No matter what your trading style is, risk management is absolutely non-negotiable. For short-term traders, you should never risk more than 1% of your trading capital on a single trade. You should also use a stop loss on every trade, and you should never move your stop loss further away from your entry price. For mid-term traders, a good rule of thumb is to never risk more than 2% of your trading capital on a single trade. You should also use a stop loss on every trade, and you should consider using a trailing stop loss to lock in your profits as the trade moves in your favor. For long-term investors, risk management is all about diversification. You should never put all of your eggs in one basket. You should diversify your portfolio across a variety of different cryptocurrencies. And you should also consider diversifying into other asset classes, such as stocks and real estate. This can help you to reduce your risk and protect your capital in case of a major market downturn. Diversification is the only free lunch in investing, and it's especially important in the volatile world of crypto. Finally, let's talk about the psychology of trading. The market is not just a collection of numbers and charts, it's a reflection of human emotions. And the two most powerful emotions in the market are fear and greed. When the market is going up, it's easy to get greedy. You see other people making a lot of money, and you don't want to miss out. So, you throw caution to the wind and you start taking on more risk than you should. This is when you're most vulnerable to a market correction. When the market is going down, it's easy to get fearful. You see your portfolio value dropping and you start to panic. So, you sell at the bottom just before the market turns around. This is how you lock in your losses and miss out on the next big rally. The key to successful trading is to master your emotions. You need to be able to stay calm and rational when everyone else is panicking. You need to be able to stick to your trading plan, even when it's difficult. And you need to be able to accept that you're going to have losing trades. It's all part of the game. One of the best ways to master your emotions is to have a solid trading plan. Your trading plan should outline your goals, your risk tolerance, your trading strategies, and your risk management rules. It should be your roadmap for navigating the market. Another important thing is to have a trading journal. Your trading journal is where you record all of your trades, both your winners and your losers. It's where you analyze your performance and identify your strengths and weaknesses. It's where you learn from your mistakes and become a better trader. And finally, it's important to have a support system. Trading can be a lonely business, and it's important to have people you can talk to about your trades. This could be a mentor, a trading group, or even just a friend who's also interested in the market. In conclusion, the crypto market is a complex and multifaceted beast, but you are in control of your own destiny. You have the power to choose your own path, to define your own strategy, and to build your own success. Whether you're a scalper, a swing trader, or a hodler, the principles of success are the same. Do your own research, manage your risk, and never stop learning. The crypto market is not a get-rich-quick scheme. It's a new and revolutionary technology that has the potential to change the world. And like any new technology, it's going to be volatile. There will be booms and busts. There will be winners and losers. But for those who are willing to put in the work to educate themselves and to stay the course, the potential rewards are immeasurable. So I encourage you to embrace the journey. Embrace the volatility, embrace the uncertainty, because it's in the crucible of the market that we are forged into better traders, better investors, and better versions of ourselves. Thank you for spending your valuable time with me today. I hope you found this analysis to be both insightful and empowering. If you have, I would be incredibly grateful if you would hit that like button, subscribe to the channel, and share this video with anyone who you think might find it useful. And please don't be a stranger. I want to hear from you. What are your thoughts on the market? What are your biggest challenges? Let's build a community of smart, savvy, and supportive traders. Until next time, remember to trade with your head, not with your heart. Stay disciplined, stay patient, and stay profitable. This is Boni from Boni's Life, signing off.